So today, our goal is to help improve your guys' life. And we're gonna, do that by saving you money, showing you how you can protect yourself. Included in that is the how to protect your business, preserve the money that you save, maybe more than you might have otherwise, and simplify and save you time. And some of the ways that we're going to accomplish those goals is we're going to show you the right structures to have your corporation or your corporate group set up in to help with the tax planning and savings. That's on the saving money side. Protecting yourself, going to touch on insurance and the different products that exist and why those are beneficial and when they can be beneficial. And similar to the structure is depending on the structure you use, you can save a lot more money in one setup versus another setup. And so we'll talk about that to a certain extent. Preserving the money you save, that's kind of more on the tax planning side. How do you pull money out of a company? What's the best way to do so? What's long-term, what's short-term planning, that kind of a thing. And finally, we're going to touch on, for a few minutes at the end, what's a good way to have your accounting and administration set up to help simplify and make it as easy as possible. We've gotten into a lot of cloud-based work in the last few years. Very familiar with a lot of the apps that exist and how to transition to those, how to optimize your accounting and your administration. So that's what we'll be covering today. And feel free, to either post a question in the chat if you have one, or to raise your hand and ask a question. It's always good to sort of stop and address something in the moment when it's fresh. If you don't want to leave it to the end, although leaving it to the end is also fine if you're okay doing that. So I'm a partner in KWB, Chartered Professional Accountants. We were founded in 1996. I was there at the time and helped found the firm. So I've been here the longest. And we are cloud-based, so we serve you guys anywhere. Yellowknife is not an issue for us. We, like I say, we'll be up in Yellowknife. Our plan is to be there 3-4 times this year at least. We might even be looking at setting up an actual storefront office there for somebody to take records, materials, and things like that. We're just finalizing that. But we certainly do all sorts of work cloud-based and with Zoom and those kinds of things. It's really easy to do. And our mission, what we truly, really believe in, and everybody on the team, I think, feels the same way, is that our job is to give you great advice, simplify your accounting, and through that, we're going to help you improve your goals, or improve your profit, help you achieve your goals, and just have a better lifestyle, right? Accounting is something that nearly everybody hates. I hate to admit it, but it's true, right? Very few people like accounting except accountants, and we recognize that and understand it, but it's a necessary evil for most people. And our job is to keep that as simple and as easy as we possibly can. And we enjoy doing that. We enjoy helping you guys out. So that's what we're going to try to do. So some very general information. Janice, I know you're incorporated. Danny, are you an incorporated company or unincorporated?
Yeah, incorporated.
Incorporated. Okay. So you guys are both incorporated, well, or hopefully I'll just touch on it, but an incorporated company is a separate legal entity, right? Separate from you as an individual. It's got its own year end. It may be December 31st, but it doesn't have to be December 31st. And if you have other businesses in the same group, which as you evolve and as the business does better and you create wealth and whatnot within the business, you probably should be having other companies, and we can touch on that, or if you have a question about that specifically, we can deal with that at the end. But all those businesses in the group should have the same year ends. It's very confusing and difficult for users, the bankers, even the accountants to try to reconcile intercompanies and things like that if you have different year ends. So highly recommend that if you get to that point that you do that. Okay. You are both, I'm assuming, small businesses and Canadian controlled private corporations, which is what CCPC stands for, Canadian Controlled Private Corporation. What's important about that is that if you are a CCPC, then you get a much preferred tax rate. It drops to 11%, which is the combination of the federal and the territorial rates. If you're not Canadian controlled, so you've got a Japanese or a Brazilian shareholder who owns more than 50%, and you're not Canadian controlled, well, then your tax rate is 26.5% in the Northwest Territories. Okay. Now, I'm assuming both of you Canadian controlled. That's wonderful. That's great. 11% is a super low rate. That then factors into a lot of our longer term tax planning because we want to take advantage of that 11%. Okay. And the important thing to note as well is that if you have more than one company, or if you're involved in more than one company and they're considered related, then you have to share the 500,000 small business limit, which I didn't touch on yet, but the small business limit is anything under that 500,000 is what's taxed at the 11%. Anything over 500, the government kind of looks at that as bigger company income, and that's at 26.5%. Okay, so we want to max out that 500,000 at 11% if we can. Okay. So controlled group is where you or somebody that you're partnered with owns more than 50% controlling interest of any companies where that exists. That's a controlled group. So you might own 25% and your sister might own 30% of one company. You might own 51% and your sister owns 10% of another company. Those two companies are in a controlled group because the same group of people, the same two people, have majority ownership of two companies. So those two companies have to share the small business deduction. Okay. So just something good to note. I don't know that either of you have that situation, but if you ever do, or you were thinking going into partnership with people or whatnot, that's just a nice thing to have a bit of knowledge on. Okay. When you're structuring your business, if you own a business with somebody else or you've got a shareholder company, we call those a holding company, then typically you would want that company or your ownership of the other company that maybe you're a partner in to be at least a 10% ownership. And why that's important is that when the government looks at the taxation of business income, if you're receiving dividends from related companies, as long as you have greater than 10% ownership, there's no taxation on that income at that time. It's only when you pull that money out of the company to yourself as an individual that there's further tax. And so that helps with the deferral and it helps to keep your corporate structure clean. So for example, Danny, if your business is doing really well, and you've got a couple $100,000 of extra income in the business, and you're keeping it in your main operating company, there's a bit of a risk with that in terms of if you're sued, if there's a lawsuit, if there's an insurance accident or something like that, that money could be at risk. So what we usually advise, if it gets to be a significant enough money, is that you create a holding company. That holding company owns 100% of the shares of your operating company typically, and then you move that money up to the holding company and invest it there, because that's probably what you were doing with that extra $200,000 or $300,000 is you were investing it in something of some kind, GIC or investments, mutual funds, whatever. And this way you can have it at the corporate level, only have paid 11% on it, and now the other 89% is growing and compounding faster than if you pulled it out and had to pay really high tax rates individually. All right. And as far as our general planning goes, we have three main areas that we like to focus on. That's deferral. And that's really what I've been talking about the last few minutes, is that with the 11% corporate tax rate and the 89% that you get to keep in the company, right? So $89 out of every 100 you get to keep in the company. You're deferring anywhere from typically 20 to 30%, sometimes even more. So that's 20 or $30 of every 100 that you are hanging on to and you don't have to pay the government. Okay, so the longer that we can keep that from the government at the corporate level, and you can do all sorts of things at the corporate level, you can invest it, right? So that's the next thing, is we keep it there. We help you, advise you on, you know, some of the things that you can do to invest it. That can be in insurance products, that can be in a, you know, easy, safe GIC, that can be in other, you know, mutual funds and stock market investing, whatever, real estate, all those kinds of things. Now you're structuring that within the company so that that happens. The ideal path is that, you know, you run a company for 30 or 40 years, we're deferring as much tax as we can. We're helping you figure out the best way to structure it so that you can invest it at the corporate level and grow it. And then when you're ready, and sometimes you want to remove money out during the course of when you're working, and that's totally cool. You can take out extra money over and above salaries or anything like that whenever you like. But ideally, in a perfect world, you know, for 30 or 40 years, you've grown up, you've grown this large investment and retained earnings in the company. And now it's time, you're retired, and now it's time to start removing it. And that's the next step that we look at is, well, what's the best structure for that? Do you have a spouse? Do you have kids? Do you have, you know, yourself? What is your tax rate? What other income do you have? We factor all of that in, and we help you remove the money from your company at the, you know, least amount of tax possible, optimizing and saving the funds and the taxes over time, so that you either, you know, have more for longer, or potentially you leave something, you know, as a legacy for your estate or for charity or something like that. So those are the three main topics that we focus on when we're developing both your short-term and your long-term tax planning. And that's some general stuff on the accounting and tax side. I'll let Brad take it over and talk about some insurance, and then I'll come back and talk a little bit more about some specifics on how to pull money out and some of the accounting advice that we give on apps and software and such.
Sounds great. Thanks, David. Yes, I'm here to talk about everyone's favorite topic, insurance. So I'm a senior advisor with RBC Insurance. I've been going up to actually all over the north, but I would say especially Yellowknife and Northwest Territories for the last 7 years or so. And that was my choice. They didn't ask me to do that. As a result, I am there very frequently, as David pointed out. Pretty much you could ask anyone from the bank about me. They all know me. A lot of them I would consider friends. So yeah, here to help and here to talk about some of the ways in which I can do that. So I'm going to do parts basically 2 and 3 right in succession. And then like David said, he's going to wrap up, and then we'll be here for questions if you have any. So to start with, we're going to talk about life insurance, just the basics, mainly because I want to make sure that some of the business related stuff that we go through makes sense, and that everything is sort of tied up. Part saving whole life is one of our preferences for corporate owned insurance. We're going to talk about that in part 3. Key person coverage, and then we're going to wrap up this first part with buy-sell funding. So on that note, next slide. So I'm going to talk about the 2 major types of life insurance quickly here. So basically all life insurance falls under 2 categories. We have term and we have permanent. So term basically means if you die in a specified period of time, it pays out. If I have a 30-year-old client and they get a 20-year term, we'll just say that they're covered until they're 50 for all intents and purposes. And the price is going to be based on that. So two major reasons somebody would get term insurance would be because it's less expensive. So even if they want permanent insurance later, they can start with this and convert it. Or also to cover, specifically defined finite needs. So let's say covering a loan for a specific period of time, covering income until they, retirement, and maybe we don't need to cover it at that point. That's where we would like to use term life insurance. And then permanent life insurance covers policyholders until the day they die. So a few hallmarks of that: guaranteed, no matter how old you get, it's going to pay out, and it can be paid up. So think about it like you bought a house, you paid off the mortgage, now you don't have to pay the mortgage anymore, and you own the house free and clear. Same idea. It's got two of the major types in most of the policies have a cash value, so you can actually access money from the policy and use it personally or corporately. Both the death benefit and the cash value typically almost always gross tax-free, and it's an ideal vehicle for estate planning. And we're going to get into that, especially on the corporate side, but it covers a variety of needs, covering tax, equalizing an estate, maximizing tax-free growth, and a bunch of stuff. And then so specifically on that, on the next slide, there are three major types of permanent life insurance. So we have whole life, universal life, and term to 100. So whole life can either be participating or non-participating. The major type is participating. That's what we have. It's the most popular kind, which basically just means that you participate in the as a policyholder, kind of like a shareholder in the growth of the insurance company. So a hallmark of whole life is that you're going to see it's going to be very consistent. Dividend rates should be pretty close to similar. At a lot of companies, you're not going to see a lot of fluctuation. So for example, right now, the dividend rate pretty much across the board is 6%. And like I said, it's very consistent. So that's why people would use that. Second, we have universal life. So it's a little bit more flexible in that you can sort of define your premium, you can increase or decrease. And instead of having consistent dividends that pay out every year, you'll always be up no matter what. The growth in the policy is going to be in the market. So if the market is doing well, your policy will increase. If it's doing poorly, maybe it decreases. And the investment will be in, think like a mutual fund or a segregated fund, basically that. And so it can be anywhere from consistent if you go somewhere, really conservative, to very volatile if you pick a volatile investment. Not going to spend any real time on term to 100, basically just a non-cash value. Here's your premium, here's how much it would pay. And then if you live past age 100, you don't need to pay anymore, but the death benefit will still pay. So next up, I'm going to give an example with whole life, which is basically what we like to use when it comes to permanent policies with companies. And so Jack is a client of mine who lives in Yellowknife, and he decides that he wants to get a permanent life insurance policy. So he doesn't own a corporation, just using this to explain whole life. So we set up a $500,000 whole life policy on him, and premiums are set for 20 years. So he's going to pay $21,000 a year for 20 years. The total amounts to about $430,000. And then if he dies tomorrow, it's going to pay $500,000, obviously, but that amount's going to grow. So for example, after 20 years, we'd actually expect the death benefit to be up around $860,000. So pretty significant growth there. And the cash value would be over $500,000 at that point too. So he's already got more than what he put in. So in this scenario, Jack's going to turn 18. So this is 30 years after he got the policy. He's already 10 years free and clear of having to pay for it. He decides he wants to move to Vancouver Island. So he owns a house in Yellowknife, and he is mortgage free, but as we know, properties are a lot more expensive there. So he's short money. So he needs about $200,000. So he goes into RBC Bank. He has this participating whole life policy, and they definitely approve a $200,000 loan at a 4.5% rate of interest because they love whole life. It's so consistent. They know they're going to get their money out of it. So it's called a collateral loan. And so in this scenario, Jack's going to die at age 90. So if you can go to the next slide. So the total amount that he's put into it is $435,000. But we know at age 80, he borrowed $200,000. And by the time he dies at age 90, that's become $313,000, including interest. The death benefit pays out of $1.6 million. minus the $313,000 that was owed to the bank. So his beneficiaries get $1.34 million, plus of course he was able to access $200,000 as well. So his net return is 1.5 and change. Pretty good return for having put in $400,000, and that all grows tax-free and pays out tax-free. So that's pretty much it for explaining it. And then I'm gonna, you
I
say
was just
something?
gonna say, and Brad, how much could he have borrowed if he wanted? Like it's almost like the whole thing, right? Or close to?
Yeah, up to 90%. Yeah, exactly. He could go borrow up to 90% of the cash value. So,
So in this
very,
case,
very robust.
he could have borrowed almost or over $800,000 if he wanted to.
Oh yeah, exactly. Yeah, exactly. Yeah, pretty good from that standpoint. Plus, then there's still the death benefit, right? So lots of liquidity there, and very good asset for him to have, especially considering he doesn't need to pay it back. And typically we'll see that the growth grows faster than the interest on the loan. So yeah, it's a great tool. And then next up, we have the key person coverage we're going to talk about. So a lot of people will have individual disability or sufficient long-term disability through their employee benefits. But what happens to your business if you become disabled or critical or have a critical illness? So I'm going to give an example here. So in the next slide, Marcia owns a psychology practice. So she has a front desk person and a counselor on staff as well. She pays rent for an office in a new building downtown, but knows it's worth it. She has more visibility there. So she's purchased individual disability coverage as well to ensure she can maintain her lifestyle if she becomes disabled. So we're not worried about that at all. We know her personal income is covered if she becomes disabled. But one day she receives some bad news. So she's been diagnosed with cancer. She's going to need to take a year or more off of work to recover. So her individual disability is going to make sure she can pay her bills. But what about her business? Is she going to be able to keep that? So she has, right now, she's paying $3,500 a month for rent. She's paying $800 a month for utilities, and the salaries for her basically front desk person and other counselor comes to what, $6,000 a month. That's over $10,000 a month she's going to need to pay, even though she's disabled. And you know, she's not there to help earn any of that income. So is her business going to survive? And this unfortunately happens a lot. We may have somebody who becomes disabled, but their business shuts down while they are on disability or while they're critically ill. So what I would have suggested to Marcia is to go back in time and go to the next slide and to have purchased a business overhead expense policy. So this covers business fixed expenses in the event of a disability to the owner. So we can cover things like rent and subscriptions and loans and amortization and salaries, basically anything that you can't get out of that you can't cancel or pause while you're disabled, right? So premiums are all relatively low. Small businesses are the only ones who are eligible. I should mention that. So if there's too many owners or there's too many employees, we might not be able to do it, but really good option. We use it a lot with doctors. We use it a lot with contractors, and it's tax deductible. So really great policy in that regard. Another great policy that we have is a wage loss replacement plan. So it's what that is it's group disability for higher income earners within a company. So often certain key employees or executives. It's a great option to help retain, to help make sure that employees and other executives understand that you hold them to be important. And it means that you can get above certain long-term disability maximums to make sure that they can fully cover their expenses if they become disabled. It's a great option, like I said, and there's even the potential for guaranteed issue. So if there's enough content, we may be able to issue everyone at standard rates and no exclusions or just no exclusions, and it's a tax deduction for the business. So really great for a bunch of business owners and key employees. Then next up, we have corporate-owned critical illness. So as I mentioned before, even business overhead isn't possible for everyone, but critical illness pretty much is, especially if you can medically qualify. So where we like this, and I actually use it quite a bit, is because it's not tied to any expenses and there's no real limit. So we can go up to $2 million payable with corporate dollars. The benefit can keep the lights on for the business. And because it's not tied to an expense, you know, an example, if I have a business owner and I say, if you become critically ill, how much is your business gonna lose in, let's say, a year? And maybe they say $1 million. Maybe I just write $1 million critical illness policy. That money flows in and they can use it however they'd like. It's tax-free, and it can be really helpful. So finally, key person disability. So this is a bit of an albatross. We don't do a lot, but it provides tax-free cash to the business to replace lost earnings to entice another employee if a very key employee becomes disabled or dies. So a good example is I had a client in Southern Alberta who had an employee who had a ticket that only like one other person in Alberta had. So if that person died or became disabled, they pretty much have to shut down. So this policy can basically help entice somebody else, maybe even bring somebody from a different country or another province, help cover some of the lost wages, help to cover trainings and expenses and that kind of thing. So last part of the first half of my presentation is buy-sell agreements. So what is a buy-sell agreement? It's a set of rules that delineates how business owners will operate in the event of a death or other reason to exit the business, and it's often part of a unanimous shareholders agreement. The rules may be clearly defined, but they're not always easy to execute. So I have a story here of Jane and Scott. So Jane and Scott own a successful consulting business. Recently, the business was assessed to be worth about $3 million in terms of based on revenue and other assets. Unfortunately, Scott was up in Iqaluit and was eaten by a polar bear. So he unfortunately passed away. And they had to go back and look at the agreement, and basically the agreement stipulated that she must purchase his shares at fair market value, which is $1.5 million. But unfortunately, and as is often the case with business owners, almost all of the corporate cash is tied up. So further, they don't have enough available credit to pay for this. So what should Jane do? Well, in the event of the death, the shares of the deceased are typically required to be sold. So where's that money going to come from? Corporate earnings or another bank loan from thin air? Unfortunately, in many cases, there's just not enough free cash to execute the sale. And so that person, the spouse or the family of the deceased, might just become your new business owner because you didn't have the cash to put together to buy them out. The solution would be corporate-owned life insurance. So it creates capital dividend account room, which we'll get into shortly. But you like capital dividend account room, it's very helpful. It can be relatively inexpensive, certainly a lot less expensive than having to fully fund the other person's shares, and it ensures the buy-sell agreement is executed. And then finally, what about disability? So interesting fact, disabilities are more likely than death. So one of the things we like to ask business owners is who assesses the disability? Who decides that the other business owner is disabled? A group that I'm working with right now, the definition of disability was basically meaningful contribution to the business. If they're not making meaningful contributions, that can be considered disabled. What's a meaningful contribution? So obviously this opens up a lot of potential legal issues or potentially impacting the business negatively as well. So what we'd suggest is to look at a buy-sell disability policy. We can cover their share of the business, and then we can be the bad guy. We can have the unanimous shareholders agreement mimic the wording of the disability policy. We can have the adjuster determine if a partner is disabled, and then at the point in which we need to open a claim, we'll assess, we'll execute the clause, we'll pay the money, and then we can redeem the shares, and the company continues operating. And one of the biggest concerns for the other partners is not wanting to kick their fellow partner while they're down. So we can be that person there. So that's pretty much it for part one. I guess my final message is sometimes on the next slide, sometimes plans need a bit more planning. So it might be clearly defined, but it does not mean easy to execute. So that's all for part two, and we're going to take a 3-second break to get ready for part three. Thank you, everyone. This is part three of the presentation. So there's three major things we're going to talk about. We're going to talk about 3 reasons why you should own life insurance in your corporation. And I think this is one of the most important parts of any presentation I give anyone. So we'll give examples for each, but number 1 is tax efficiency. Number 2 is investment in liquidity. And number 3 is estate maximization. So in order to go through that, I'm going to give you actually, first I'm going to talk a little bit about what we like to use. So we like using life insurance in your corporation for a few reasons. So first of all, because it's insurance to cover business loans and expenses, because often the bank requires you to have it, or just because you want to have the company continue operating, and it's insurance first and foremost. Second would be for tax advantages. So using corporate dollars, which of course are taxed at a lower rate than personal dollars, and because it creates capital dividend room. So I have learned the hard way. I need to stop trying to explain how the capital dividend account works, but I'm just going to make it even simpler. Imagine you have $300,000 of capital dividend room in your business, and you decide to take $300,000 out of your company. You can claim it as a capital dividend and take it out tax-free. So life insurance in your company allows you to create capital dividend room. So basically, take money out of your corporation tax-free, and we're going to get into that. It's a great option for succession planning, as I said before, equalizing an estate, getting money out of the company in a tax-free way, covering tax bills on death, and a variety of other things. And so next slide, we personally prefer, if we're using permanent life insurance, and in the long run we like purchasing whole life for corporations. And the reason why is threefold. So first one would be because it's consistent returns. We know companies, corporate earnings can be very volatile. This is not. It's very consistent, almost boring in a lot of ways. It will always increase at a steady, healthy rate of return. You're never going to see the 20% increase, but it's never going to decrease either. The second reason is because tax efficiency is maximized in old age. If we have a policy owned by the corporation, and somebody reaches old age, in many cases, the entire amount it creates capital dividend room. So if $1 million payout, that's a full $1 million capital dividend. And even if they die before old age, it can still be mostly capital dividend account room. So very, very helpful for the company. And finally, for business loans, as David was mentioning before, you can take up 90% as a loan. So you can use that for business loans, to keep the business going, to expand, whatever you might need to use it for. And lenders typically really like whole life because it's so consistent that they're guaranteed to get their money. So I'm going to give you an example for part one. So Jay is 50 years old. He owns a successful consulting business, and he's been looking to leave an inheritance and build a legacy for his family. So he has two daughters, Vanessa, who's 28, and Lucy, who is 26, and he wants to leave each of them $250,000. And he wants to at least have that amount grow and keep pace with inflation or better. So I sit down with him, we look at an idea of a 10-year pay. So he's completely paid off after 10 years. It's going to be about $35,000 a year. So over 10 years, he'll put $350,000 in. If he dies tomorrow, it's going to pay out $500,000. And let's just say in this case study, if he dies at age 90, it's going to pay out over $1.6 million. So he's in, he loves the idea. That's already established. But the only question we have is, how should we structure it? Should he pay for it personally, or should his corporation pay for it? So in that vein, Jay pays himself $240,000 a year. He lives in Yellowknife. And let's just say that entire amount is spoken for, mortgages, whatever it is, right? So in order to pay the $35,000 a year, based on current tax rate, he'd actually have to take out almost $67,000 a year to get that $35,000. Alternatively, he can pay for the policy through his company. In this case, his company would pay for, and be the beneficiary of his policy. If he dies at age 90, he's only put $35,000 in. He didn't need to pay income tax or personal income tax to take it out. And so what's going to happen, as I already explained before, is that $1.64 million is going to pay into his company, but now it's created a capital dividend equal to the amount that paid out, which means that his daughters can basically access that cash through the capital dividend account tax-free. So final slide for this. So option number one, Jay can pay $666,000, or he can pay $353,000. So option number one is double the cost. So the net result is the same. His daughters basically get the same amount of money, but the net cost is drastically different. So why would he not just have it owned through his holding company? He probably would. So reason number one is tax efficiency. It's very tax efficient to own life insurance through your corporation, and it's a great way to funnel money in and out towards your beneficiaries or for succession planning. The second reason, so we're gonna have Karen. Karen is 48 years old. She owns a construction company, and she decides that she wants to open a satellite office in a different community, and she needs about $1 million to do so. Unfortunately, she doesn't have enough liquid capital to do this, as is the case with many business owners. They might be asset rich, but sort of liquidity poor, not a lot of cash to take out. So then she remembers that she secured a par policy 15 years ago and has been investing into it for 15 years at about $156,000 a year. So now the death benefit has grown from $5 million to $8.2 million, and the cash value has grown to be $2.5 million. And she remembers she can just do a collateral loan. So she goes into the bank, they offer her a collateral loan for $1 million at prime plus 1% interest. She has the option to pay off the loan or keep it going. It's a collateral loan, so she's not obligated to pay it off. She can borrow up to 90%. She's only even accessed $1 million out of this $2.5 million. That's still basically $1.25 million more that she's allowed to access. And then the interest in the policy on the death benefit in many cases is going to grow faster than the loan interest. So she's still able to kind of have her cake and eat it too. And so that's the second reason, liquidity and investment. Another great reason to own life insurance in your corporation. And then finally, Frank is a small business owner, 45 years old, and he has 2 sons. And his sons as well own shares in the corporation. So his financial plan indicates a surplus in retirement. There's no need to use corporate assets for his retirement. He currently has a very healthy retirement plan outside of the corporation, but he also has $600,000 in a corporate investment account as well that he can access. He's contributing an additional $60,000 a year into the corporate non-registered savings account. And right now he's invested in a balanced portfolio. So in this case, let's just say 5% rate of return. We're going to keep that consistent the whole way. It's going to be an equal mix of equities and interest incomes, which are taxed at different rates. But he heard someone talk about a corporate estate transfer strategy, possibly using life insurance to help leave money behind. So let's compare. Like he can invest $60,000 a year for 20 years, or put it into participating whole life for 20 years. And so in this case, he's going to be 45. He's going to do it until he's 65, and then he's not going to need to pay any more or invest any more. And then he's going to die at age 85. So to start with, let's look at annual tax on growth. So every year he puts in $60,000. So through his corporation, he's going to have to pay annual tax on the growth on the mutual fund, but he doesn't for the life insurance because the growth is non-taxable. Second, when he passes away, his corporation is going to have to pay tax on the capital gains on the mutual fund, but he doesn't on the life insurance because it grows tax-free. So after all the tax due, the net amount that's available at age 85 when he passes away through the mutual funds is $3.1 million. But the amount that's available through the life insurance is $5.8 million, which is obviously significantly more. And then if we were to try to take out the full proceeds from the corporation and funnel it into his estate, he'd have to pay personal tax on the dividends claimed for the mutual funds, which is almost $700,000, but just shy of $30,000 if we took out the $5,830,000 of life insurance. And so the net amount to the estate in the end is $2.4 million for the mutual fund, but $5.8 for the life insurance. So by using the capital estate or the corporate estate transfer strategy, he saved $3.4 million. So it's not that the rate of return is necessarily higher, but the net result after tax certainly is. So last couple slides. The first one is just to show if we were looking at just tax due on the same investment over the same period of time, life insurance slaughters everything else. Capital gains was second best at just over $2 million less than the net proceeds from the life insurance. And then next, my favorite slide, which is the end internal rate of return on the insurance ended up being 5.17%. Well, I already said it was 5% on the mutual fund, but yet the net result was under half what it was for insurance. And the reason why is because all these check stops of tax that we've eliminated. And just to put into perspective, think interest income, so GICs, bonds, we'd need almost 12% of this return to equal the amount that they got through insurance. So that's the final reason. Estate maximization, one of the most effective ways of maximizing an estate. So to summarize, basically there's 4 major reasons why you'd want to own life insurance in your corporation. Next slide. Yeah. Basically just, we're not saying only have life insurance in your corporation. It's part of the chemistry set. Still have your mutual funds, your other investments, your segregated funds, but make sure that you have life insurance as, certainly consider life insurance as an important part of the portfolio because there's a lot of advantages. So to summarize, there's 4 major reasons to consider life insurance in your business. Tax efficiency, funding that eventual tax bill that is more likely to come than not. For investment and liquidity, because being able to access cash for your business, even being able to access cash in retirement. Did you know you can give yourself a loan and pay a prescribed rate of interest and not pay tax? In terms of protection, it's insurance after all. So funding those buy-sell agreements that we talked about before, protecting those key employees, those executives, yourself, to cover business loans and long-term leases. And finally, for estate maximization, to create and protect an estate, to equalize an estate. Maybe one of Frank's kids wants to take over the business and the other one doesn't. Now we have a whole bunch of tax-free money we're able to access to equalize or make the estate more fair. And then finally, for asset preservation and wealth transfer. So, and that's the summary. So protect your, last slide there, protect your key people, make sure your buy-sell agreement is funded. Corporate-owned life insurance is an incredibly important part of the investment portfolio in a company. And a corporate estate transfer is one of the most important and efficient ways to perform a variety of activities regarding leaving succession planning, leaving money behind. And as always, Ask an Advisor, this is what I'm here for. And I certainly work a lot with clients, both in Yellowknife and in the Northwest Territories. And then I will pass it off to David to wrap us up here.
Thanks, Brad. In some ways, some of what you said seems almost too good to be true. But I'm starting to understand the whole insurance products and such better. And I think actually there are some really, really great opportunities there. You start looking at it and it's like, okay, there's some really great rules that the insurance industry has lobbied for and received over the years. And I think it's worth looking at for sure. So I'm looking at it more closely for sure for both myself and clients. So.
Yeah, thanks, David.
Yeah. So I wanted to touch on, you've listened to me, you've listened to Brad, you've got a bunch of money in your company. You're making money year on year, which is great. You're also building up a war chest or a nest egg, which is great. How do we get that money out of the business into your own hands? Right? I mean, it's great to have it in the company. It's great to look at the numbers and know you've got access to a large sum. But there's times when we want to get that out. What's the best way to do that? So there's really 3 main ways. There's 4 listed here, but earnings stripping has basically been removed as of January 1 of 24, just because of some tax rule changes and whatnot for the most part. So really not applicable. So you can take a salary. Most of you would be, we're all familiar with that. You can take dividends. You may or may not be as familiar with that. Or if you're more in the startup earlier years, you might have put money into the company to begin with, and now you're able to pull that out. That's probably the easiest one to talk about. I'll just quickly say, again, it is what it sounds like. You started up a business, you had to invest $20,000, $50,000, $100,000 initially. That's a shareholder loan, or maybe as you go through the year, you're paying for certain things that you didn't have the company credit card with you, so you paid personally, or there's just certain expenses that you paid, or you're using part of your house, or you're using your automobile, or that kind of a thing. Those are all contributions you're making to the business, and so you're able to get paid back for those, right? So we want to make sure that we track those and we pay you back for those, and that's an easy one to do because it's tax-free. Salaries and dividends are the two main reasons, or two main, not reasons, but two main ways to take money out of a company. And they're quite different. A salary is an expense to the company. So it comes out before taxes are paid. It creates a deduction for the company and it reduces the corporate income. However, as I talked about earlier, your corporate tax rate might only be 11%. So you don't really need a deduction as much as you might think you do, right? So that's why we might look at other options. A salary increases your RRSP room, which can be beneficial. That's a whole nother discussion, a whole nother presentation that I sometimes give on different types of investing and whether RRSPs are good or not. I'm not, generally speaking, a big fan of RRSPs, but they are a tool sometimes in the tool chest. So salaries increase your RRSP room. If you don't have salary, you don't get RRSP room that year. Salaries require a CPP contribution. Now that can be a significant amount, and that can almost be considered, if not like another tax, it is another expense. And so you need to consider that. CPP has crept up significantly over the years. If you max out your CPP, you're now looking at almost $6,000, almost $7,000, I think, a year expense, right? So if you can avoid that, that might be $7,000 in your pocket. Okay. Salaries, if you're the owner and the operator of the business, salaries can kind of be any amount you want them to be. Anything is pretty much reasonable. If you're paying salaries to a related person, they need to be reasonable. And so we need to talk at times about what that is. It's not always black and white. Depends on a lot of factors like what's the revenue and profit of the business, what's the importance of their role, how much time and effort do they put into that, how important, like critical a role is it, that kind of thing. You could potentially pay a spouse $100,000 in one company for doing the exact same thing that you might only pay them $10,000 to do in another company, right? All depends on the circumstances. Dividends, switching gears to dividends. Dividends are very different in that they're paid after the taxes of the company have been paid. So if you have $100,000 of earnings, you can pay a $100,000 salary, you pay no corporate tax, but it's all taxed personally. If you have $100,000 income and you pay the tax first, $11,000, you're left with $89,000. You could then pay a dividend of $89,000 to yourself or to any of the other shareholders. The government realizes there's a difference in the calculations there, and so the tax rate on the dividends is less, so that at the end of the day, no matter what you received, it should be the same amount of tax. So if you ended up paying $40,000 of tax for the salary, you'd probably pay like $29,000 of tax on the dividends. So at the end of the day, a total of $40,000 was paid. That's what they try to do, but there is a bit of leakage, we call it, in the integration. It's not always exactly the same. It can be 1 or 2% one way or the other way. And part of my job is to figure that out for you and determine what's the best, either of those options, what's the best in that year, what's the best down the road, that kind of thing. Dividends do not create RRSP room, so you got to consider that. But there are no CPP contributions required on dividends. So often, if somebody has paid into CPP for a good chunk of their life, we will switch strategies and we will go dividends for a while because they avoid the CPP. And most people don't know this, but if you don't pay CPP for 7 years out of your 42-year work history, it doesn't affect your benefits. So you're basically paying an extra 7 times $7,000 that you don't need to maybe be paying. And so we will switch people over to dividends. Maybe they're 50, 55. They've paid CPP for 30 years. They don't need to keep paying CPP as much. They're not getting any extra benefit from doing it. So let's save that money. So we'll switch for that reason. Dividends are funny if you've got a family member in the business. The family member can't receive, the family member can receive dividends, but the dividends are taxed at the highest rates tax-wise, and so they're not great. And we don't pay dividends out to family members unless they've been involved in the business and they work more than 20 hours a week in the business. And that's anytime in the last 5 years. If they've done that, then they can receive dividends. If not, any dividends they receive are taxed at the highest rates, and we want to avoid that. That's called tax on split income, or TOSI, and that does come into play, and sometimes you'll hear that being mentioned and whatnot. So anyway, when it comes to being sort of the whole tax plan, and you've got other family members or other people involved in the business, it's important that you talk to me about that, and we figure out the best way to optimize that, make use of their tax brackets, make use of your tax brackets, and let's pay the least amount of tax possible. Okay. So that's a big part of the tax planning that we do on both an annual basis and on a long-term basis. And sometimes it may make sense to pay a bit more tax this year, because over the course of 5 years, that's going to result in a lower tax. And that's what we'll look at as well. Things like OAS come into play, the CPP I mentioned, that kind of thing. All right. Last topic area that I wanted to talk about, and I will finish close to 2:30 if you can hang on just a couple minutes if we run late, but it'll be close, is to just talk about what we feel is super important in running your business, which is having reliable and meaningful bookkeeping information. We started to provide bookkeeping support about 6 or 7 years ago, when the technology and software became available to do that remotely and in a cloud environment. So we highly recommend QuickBooks Online. It's our software of choice. There is other software out there. We can help support it, but we're really only taking on clients that are using QuickBooks Online. What's beautiful about that program, as well as others that are cloud-based, is that they're leveraging AI. They've been leveraging AI for years. That's it's the most recent buzzword in the last 12 months kind of thing, AI. But what that software does is it is utilizing it even more than it ever did in the past. And it reads your bank statement information by going online and what they call scraping the information. It helps populate the transaction in your software, and then matches it to pictures of receipts that you might have taken. And all of that leads to more accurate, right? Because you've got computers reading the numbers. And yes, can errors happen? Sure, you can have a smudge on a receipt. You can have, something go wrong on your bank statement or something like that. Very rare, though. Much more rare than the normal human errors that occurred, right? So much more accurate bookkeeping, and it's happening almost real time. So the timely reporting is there. Depending how often or frequently you're actually doing the bookkeeping, or somebody is helping you doing the bookkeeping, or if we're doing the bookkeeping, that can mean you can have information that's up to date as of today, or as of the end of the week, or whatever you'd like it to be. So you're now able to make much better decisions based on the information that you've got, right? It's much more timely and accurate. Okay, so migrating to cloud is fairly easy. We've done it for 200 clients. We continue to do it. We've got a couple that we're doing this month. We're very familiar with it. It takes maybe a week in total. It involves looking at your information from what you had. I know, Janice, we've been talking about that. I think you've got something lined up with Shelley, or she's trying to line something up with you to talk about that. But it's taking your Sage or taking your QuickBooks Desktop and working with those. We do that. We take that. We upload it into QBO. We modify it slightly. Do what we need to do in order to have it properly set up for you. And like I say, within a week, you're ready to go, and you're in QBO and it's all set up. We'll help you connect your bank and your credit card feeds, we call them, to QuickBooks Online, so that information is now going in there, regularly. There is the odd time that there's a disconnect between those feeds and QuickBooks Online. The bank might update their software. They might, do something that causes a disconnect, and you will have to go in and reconnect. I have to do it periodically with the companies I'm involved in. Takes 2 or 3 minutes, so it's not that big a deal. Okay. But once you're in the cloud, it will save you time and energy for sure. And it does improve accuracy and accessibility. The last thing on there means that I can access it easily. You can access it easily. Your bookkeeper can. You know, you have a question, you call me up. We don't have to guess about something. I can go in and open it up and look at it right there and there with you. I can share it on our Zoom call. It's just so much easier to deal with information when when it's that accessible. Right. So, and if you work with us, we actually provide the licensing of QuickBooks Online for your company, because we get a preferred rate as a preferred vendor, and we build it into the monthly agreement that we have with you. So it's all covered. And lastly, with one of the other things that we can help you do, and I think provides a ton of value, and I think a lot of other firms don't do this, is we can come in and do what we call a workflow optimization. We take a look at your chart of accounts. We take a look at your structure. We take a look at what it is you're trying to do, and we organize and structure your QuickBooks Online in such a way that it meets those needs. Right? If you've got multiple locations, if you want to track your revenue by jurisdiction, if you want to track your revenue by industry, or anything like that, or by salesperson, even, there's different ways that it can be tagged, it can be classified, it can be manipulated in QuickBooks Online to give you that information. Bookkeeping and accounting has grown and changed from simply providing you a scorecard of what you did to a much better management tool, because of the fact that we can do cloud-based accounting and with all of the AI features that are in there. So we help you understand your business better. We help you figure out the better way to slice and dice your information so that you can make better business decisions, and hopefully drive your profit, drive your revenue, to make your business even more efficient. And in addition to just QBO, there are hundreds of apps that help run different processes better as well. So 2 or 3 that we highly recommend, and we pretty much bundle it for every client that's an operational business, is Plooto, Plooto. Plooto helps you pay your bills and also receive money online. So it's like a banking EFT program, but it's cheaper and easier to use. Dext is a receipt capturing program. So you can take pictures on your phone or scan it or receive emails that you forward to a special email. And now you've got backup for every single expense in your business. Wonderful for 2 reasons. Number one, you're trying to analyze an expense category and wondering if you can cut anything, or what you're spending your money on. So you can go through and do that. But number 2, you get the god awful CRA letter. Hey, we want to look at your travel expenses for 2022. You're not trudging up into a dusty room somewhere to pull out a box of receipts that's going to take you 20 hours to go through. You simply go to your QBO, you print a report, and you just click on the expense line items that you want the receipt for, and the receipt's right there. Picture's been taken electronically, and the PDF is right there. So hugely beneficial, to use Dext, and that's DEXT, and go from there. And then there are lots of different programs, some that help you collect your receivables, some that help you do your invoicing in the field if you're a business of that nature. Some that help with inventory management if you've got inventory. All sorts of apps that can help in all sorts of ways. Basically, you invest a few $1,000s, to get it implemented and to pay for the fees, and it replaces, one whole person or half of a body, or those kinds of things, and you can get to where you're streamlined to be lean and mean. And I think that's about it.